Good afternoon, everyone, and thank you for joining us on today's webinar to discuss Yorkville's new MLP strategies, the potential effects of Trump's proposed tax reform, and the booming frac sand industry. My name is Will Hershey of Yorkville Capital Management, and joining me from Yorkville today will be Chief Investment Officer Darren Sharinga and Portfolio Manager Len Edelstein. If you have any questions during the course of the prepared presentation, please feel free to type them into the text box in the bottom right corner of your screen. We will hold a Q&A session at the end of the call, and we'll do our best to answer everyone's questions. With that, I will turn the call over to Darren for prepared remarks.
Thank you, Will, and thank you all for joining us for our quarterly conference call. I am going to begin with taking a look at, not only did we roll out a couple of new strategies that we have been incubating over the last year and a half, but we upgraded our website and enhanced it at the same time so that it really becomes a source that MLP investors can use to help inform investment decisions, and ultimately what it's designed to do is to improve investment performance by using some of the not only bespoke but information that is proprietary to Yorkville that is only published on our website. So again, if you've never been on our website, it's yorkvillecapital.com. We'll hope you take a look, and this next slide shows the new layout of the home page. A couple of things that are unique to the website. I'll point out here briefly, the K1 tracker is one of the most popular features on the website historically. We launched this a couple of years ago. It was designed to help MLP investors simplify their taxes. What the K1 tracker does is pulls together 100%, again, the entire population of MLPs. When they publish their K1s online, you can track it through the K1 tracker. 100%, this bar here means 100% of the companies have published their K1. Click through or the link, and it'll take you to the company's website, and ultimately where you can publish your K1 online. We'll be introducing new trackers this year. Again, it's designed to keep MLP investors abreast of changes in the industry. We'll be looking at one that will look at distributions on a quarterly basis and provide some analysis as well as earnings on a quarterly basis. So those will be a couple of new trackers we'll be rolling out over the next couple of months. Right beneath that, performance best and worst. If you drill down into this, which is clicking on the MLP performance on a month-to-date basis, you will see the best and worst across the entire asset class. If you're trying to get a feel on a security-by-security basis, what's happening within MLPs, how your securities are ranking, relative performance, you can drill into that. We also have a fundamental page that looks at fundamentals on MLPs, but we won't touch on that today. One of the bigger changes on this version of the website is really to your right. Yorkville MLP indices, and I'm going to touch on that more on the next slide. When we introduced our suite of indices, it was something that was unique in the asset class. Number one, we looked at the existing benchmarks and said these are really not great investment products and they're not great benchmarks. Can we do something better? And we did. We created a benchmark that looks at the entire population of the MLP asset class versus a sample, and then market weights it so that it's reflective of what's going on across the entire asset class. And so that covers our first three indices here on the page, the universe, infrastructure, and commodity. The universe index is 100% of all MLPs, and then we segmented the asset class into really infrastructure, long-term contracts, hard assets, and commodity, which would have more commodity exposure within their business model. We've introduced a couple of new ones, and we'll be rolling out more over the course of the year. We're starting to get into style, and as the MLP asset class continues to grow, and as the U.S. energy revolution continues to mature, and we're talking about decades here, not just over the next few quarters or months, investors need more information and more granularity. So we rolled out a couple of style indices, a large cap, growth index, and then below, finishing off looking at the sectors, we classified the universe into 10 different sectors based on the fundamental business drivers of each company or partnership, and we came up with 10 different sectors, and that ultimately these sectors fall into either the infrastructure or commodity segmentation of the asset class. Again, this data is available, some of it exclusively on our website, some of it's available on Bloomberg, all of it's available on Reuters and Selective's website. We're trying to make it simple for investors to get it all in one place, and that gives the investors the edge if it's not data that's readily available elsewhere, by getting it here and seeing what's going on across the asset class. Again, should help inform your decisions, and we would, again, hope that that would improve or help you make better investment decisions when it comes to MLPs. A couple of things that we want to point out here on the index is that it's updated on a weekly basis currently, so you don't need to check it every day. You can come in once a week and see what's transpired and changed. The stability score and growth scores, again, the stability score is a measure of quality. How good is the distribution quality, and then the growth is how fast your distribution is growing. So a stability score of 10 means 100% of all companies. So in the universe, that would be 100% of all MLPs either maintained or increased their distributions over this period, and the growth scores how fast they grew their distributions. So by publishing this on all of our different indices, we're giving investors the ability to now look at relative quality. So what sectors are have higher quality earnings or had higher quality earnings in the most recent quarter, and what sectors are growing faster, or what segments or styles within the asset class. So if you look at the stability score, growth MLPs, 100% maintained or increased distributions in the most recent quarter. Going under the sectors, general partners, marine transportation, natural gas pipelines, and refined product pipelines also have 10s, meaning 100% of the partnerships within each of these sectors or style indices maintain or increase their distributions. And then looking at growth, ultimately what underpins the investment thesis behind MLPs, which MLPs are a total return investment, is not only current income, how much income are you getting, but the quality of the income, and it's not being cut. And then most importantly, how fast is the income growing is the primary driver of price return or price appreciation over time. So looking at first of all, the segments and styles, you can see MLPs overall grew 2.5% across the entire universe. Infrastructure MLPs, again, pipelines, storage facilities, long-term contracts, grew at 6.9%, almost 7% in the most recent quarter. Commodity MLPs, those that have some commodity exposure, saw negative growth rates, which brought down the entire asset class. And then large cap didn't do that well. Large cap grew 1.3% in the most recent quarter, and growth MLPs, which these are the fastest growing partnerships, so the distribution growth leaders, doubled the rate of growth of infrastructure. Moving aside to performance and just staying within the top portion of this chart right now, you can see on a year-to-date basis, growth MLPs up 4%, the universe up 1.7%, and infrastructure MLPs up 2.2%. It's interesting. Growth rates correspond to year-to-date performance. Commodities, negative growth rates, negative performance on a year-to-date basis. And the same analysis can be done on the bottom sectors. You look at energy services, distribution growth rates down almost 25%, down 11% year-to-date. Natural resources, distribution growth rates down 1.5, down 4.6%. And some anomalies, crude oil pipelines actually had a slight increase in distributions, but have experienced negative growth going through. You can drill down or click onto any of these indices. It'll take you through to the index page where you can, again, do further analysis on the various indices we're looking at. So this is an area as we continue to roll out new indices that are proprietary to Yorkville. We'll be looking at new sectors, new ways of gaining exposure to the asset class, and be adding them to this table. So a great way of getting an overview of what's working within the MLP asset class, or really the U.S. energy infrastructure asset class, and what's not working and why that is. So we actually use it as part of our investment tools, looking at our portfolio holdings as well as looking for investment ideas across the various investment strategies we manage. So I think this, I don't think this next page is something that you, as investment advisors, can show your clients that you've been wise in keeping them in MLPs. This chart here, or line graph, shows the year-to-date performance of MLPs relative to other energy industries or subsectors, however you want to look at it. So the top line actually shows the Yorkville MLP Universe Index. The dates are the same. It goes through 5/12. The previous table went through May 12th as well. So from the beginning of this year through May 12th, the Yorkville Universe Index, which again is the entire population of MLPs, was up 1.7%. You compare that to the energy sector, which is the S&P 500 energy sector, down 9.4% on a year-to-date basis. S&P 500 Exploration and Production Index, these are your companies that actually drill for oil and natural gas, down almost 15% on a year-to-date basis. And finally, Oilfield Services, these are the companies that provide the drilling services, down almost 20% on a year-to-date basis. So to put that relative to oil, oil was down 11% through May 12th of last week. So MLPs have held up for the year, slightly positive. Other energy sectors, much more highly correlated with oil recently, and have really given investors a painful investment experience through the beginning of 2017. So a great chart to show clients that MLPs, due to their, again, non-cyclical nature, long-term contracts, more akin to a real estate investment in terms of stability or utility, the way the rating agencies look at the cash flow from MLPs. It's shown in performance right now, not tied to commodity prices over the short term. So that's a background on knowing what's going on in the asset class year to date, but comparing MLPs relative to other segments of the energy industry. The next part of the presentation deals with the two new strategies that we've introduced, and you know, over time that these are both actively managed strategies. Over time, Yorkville has a history of being innovators within the asset class. We were the first to introduce an MLP ETF that was a high-income MLP ETF. We focused on the commodity segment of the asset class at that point. We've changed the strategy here in an actively managed basis where we're looking for MLPs that are high yielding but also providing high quality income, which is a cornerstone of the way we invest. So the Yorkville MLP high income strategy, its current yield is 10%. This is a great investment a great vehicle for investors looking to augment their income in the portfolio. Interest rates are low, they may be rising. We actually hope they are rising for a number of different reasons. It means the economy is doing well primarily. So a great way to deploy a little bit of capital towards income and show a lot of income across the portfolio using the Yorkville MLP high income strategy. The second strategy that we've introduced here is the Yorkville Energy Infrastructure Strategy. This invests in C Corps or general partners. It's a great solution because it addresses the tax concerns of both institutional and foreign investors for them to gain access to the asset class. It's also capitalizing on a growing trend that we're seeing with MLPs. There's a lot of, and it's not MLPs, so keep in mind MLPs are a structure. They're not an asset. So MLPs own underlying U.S. energy infrastructure assets. Our expertise is investing in U.S. energy infrastructure companies and U.S. energy companies, whether it's structured as an MLP, which is a pass-through entity, or whether it's structured as a corporation. The businesses are the same. The underlying assets that they own are the same. So we're really agnostic and have been over our history, whether it's a C Corp or an MLP. We've now actually taken that a step forward and introduced a product that that actually invest in MLPs primarily that are structured as C Corps. So the trend that we've seen in the asset class recently has been what's called simplification. It's the roll-up of the GPs and LPs into a single entity. Not always a single entity. Sometimes there's a tracking stock that is structured as a C Corp that gains exposure to the underlying partnership, again, without the tax complexities of partnership taxes. So that's been a trend. We've also seen other U.S. energy infrastructure companies just go public as C Corps and not opting out for the MLP structure. We also, a year and a half ago, witnessed KMI, Kinder Morgan, restructure itself as a C Corp from an MLP. So we don't want to limit our investors from accessing U.S. energy infrastructure for the quality of the cash flows that these assets produce, and now by coming out with a strategy that focuses completely on assets held by C Corps gives investors a fresh way to gain exposure to the asset class and continues on our innovative strategies that we've demonstrated in the past. Finally, we rebranded our growth which was our MLP core income strategy, to the Yorkville MLP growth opportunity strategy. That is appropriate, not only that we've rolled out new strategies, but is also more reflective of the way that we've invested in MLPs. So again, we've stated for years that MLPs are a total return investment, that the larger percentage of your total return ultimately comes out of price appreciation or capital appreciation, not from your current income, and the primary driver of price appreciation is growth in distributions. So in order to maximize total return, we've looked for companies that are partnerships that have been growing their distributions at the faster than average. All of our investments are driven by fundamentals, and that's part of the reason we're able to provide the bespoke or the proprietary research that we do on the website for free to investors, because it's part of the process and the discipline when we look at companies, what we use, and we're just extending it, again, for free to the broader investment community. It is part of our investment thesis and methodology is we're looking for high-quality income. It's not just enough to have fast-growing income or high income. We want to make sure that we have high-quality income. And how do we measure that is in terms of distribution cuts. That's where the stability score also comes into play. So high-quality income is a company that is not going to cut its distribution. What we've seen in our flagship strategy, which is now moving into its 16th year, one of the oldest MLP strategies in existence, is that from 2008, the downturn of 2008, the Great Recession, and then the Great Energy Recession of 2015, we've had no distribution cuts in the portfolio, and these are great times to stress test actual investors and investment managers to see how they've performed in down markets. Our portfolios have done exceptionally well on a fundamental basis, no distribution cuts. Your income safe, extremely important if you're looking for high income. So what we've done is we've leveraged our core competency as researchers and stock pickers into new strategies. So we've taken what we've done in our flagship strategy over the past 16 years and leveraged that into now investing in MLPs that have high quality, high income, as well as energy infrastructure companies with the same high quality cash flows that they're producing over time. So as we've added new strategies, fundamentally nothing's changed the way we look at the companies. It's just new ways of gaining access to the asset class. Nothing different than we've done when we introduced our rules-based investment strategies that gave investors different exposure to U.S. energy infrastructure. A little more on these strategies. The Yorkville high income strategy, the benefits of it, it's higher current income clearly, it's yielding 10%. It's hard to find quality income at 10% anywhere in the world at this point. It's tax advantaged income because it is MLP income, so a percentage of that, generally a rule of thumb, 80% of the income is tax deferred. It's inflation protected income. It has the potential for growth, and with the potential for growth, it has a potential for price appreciation. So I'm really you're looking at the Larian Index is at March 31st paying 7%. It's a 300 basis point uptick in income. I highly recommend it if you have investors that are living on fixed income and looking for ways of improving and increasing or enhancing their current income flow. Strategy description in the right-hand corner, I won't go over that. You can read it. It's also on our website under investment strategies. Yorkville Energy Infrastructure Strategy, I've touched on it a little bit. The primary benefit, fewer K1s, really to no K1s. We'll no longer invest in general partners, which we have historically, that are structured as partnerships. The reason we don't want any K1s is because with no K1s, we have removed the tax burden for tax-exempt entities with UBIT and for foreign investors who are direct investors or investors in a partnership. It creates all types of tax complexities given that they're C-Corps. It simplifies that. So C-Corps, interestingly enough, because there's a larger investor base, also tend to have more liquidity, which is a good thing from an investor standpoint. And looking at the philosophy of how we invest in the energy infrastructure companies, it really closely, we say in the investment style total return, as we've talked about for MLPs, it closely mirrors what we're doing in our flagship strategy. We're looking for growth, MLPs, high quality growth. It's just a different investment vehicle. They're not partnerships anymore. They're structured as C-Corps. So as you can see here, March 31st, EBITDA, because again, distribution growth isn't as relevant to C-Corps because they're not pass-through entities, but EBITDA becomes more of a relevant metric. 20% EBITDA growth relative to the Larian Index, which grew at 1.2% in the first quarter. Moving on to what's affecting and has potential to positively impact the MLP asset class. President Trump's proposed tax reforms and MLPs. We published a piece on this in one of our MLP beats. There's two areas of President Trump's tax reforms that will have a positive impact or the potential for a positive impact on MLPs if they get passed. The first one is pass-through tax rate, and the second one is the corporate income tax rate. The pass-through rate affects MLPs. Again, they're pass-through vehicles. They do not pay a corporate income tax. It also affects LLCs, LPs, really your S-Corps as well. This pass-through tax was designed to incentivize small businesses to reinvest the income that they're no longer paying in taxes back into the businesses. Small businesses are the largest generators of jobs, contrary to what you would imagine is that big businesses create jobs. No, it's actually small businesses create the majority of the jobs in this country. How can the government, through taxes, incentivize greater investment in the businesses? And this was one of the ways of doing it. Well, given that MLPs are pass-through vehicles, they will also benefit. The current marginal tax rate at a federal level for an individual is 39.6%. The pass-through, the rate would drop to 15% for pass-through vehicles. So it would be in line with what the proposed tax rate would be for corporations. And that is, the idea is to put, again, level the playing field for LLCs relative to C-Corps. The second part, and I've just mentioned it, the corporate tax rate being reduced from 35% to 15%. How do these affect MLPs positively? The pass-through tax rate increases the after-tax income that investors receive. So that is clearly a positive. It means more money stays in the pockets of investors in MLPs. The corporate tax rate being reduced from 35% to 15% increases the returns of MLP funds which are structured as C-Corps. That's a mouthful. Any fund that has more than 25% of its assets invested in MLPs, so pure MLP funds, have to pay a corporate tax rate of 35% plus state and local. So by reducing the tax rate, you're increasing the returns of the funds. And so which will improve both of these. The pass-through reduction in tax rate, the corporate tax rate, will improve the performance of MLPs and will ultimately make the MLP structure more attractive to investors. And this should increase investor demand, and based on the law of supply and demand, the more new investors we bring into the asset class, the more it should drive prices up, potentially for a re-rating in the asset class, and which would be good for existing investors in MLPs. So, examples on both of these. So the first one is the pass-through tax rate. The current tax rate, as you can see on the bottom of the first bar, is 39.6%. The proposed tax rate is 15%. It's looking at $1,000 of income in this example. Currently, $1,000 of income being taxed leaves the investor with $604 at 39.6%. When that tax rate drops to 15%, the investor is now left with $850. That's a huge increase. It's a 41% increase on an after-tax basis of income to the investor. So that's from an impact on the asset class, this may even have a more meaningful impact than even the lowering of the corporate tax rate. But clearly, more income that the investors get to keep on an after-tax basis, more attractive, and the better the total returns are, more attractive the investment becomes. The second benefit in this example looks at the corporate tax rate again. If you look at the first bar with a 55 on the top, the current tax rate is 35%. The next bar is proposed tax rate of 15%, and the third one is no tax rate, and it has an 85% on the tax. So on the top, what we looked at here, and what this graph is showing, is the returns of the Alerian Index over a 10-year period from April 2007 through April 27. An investor who owned the positions in the index outright would have seen a return of 85% over that period of time, so just shy of a doubling of their money. The current way that MLP funds are taxed at a 35% rate at a federal level, the returns to the investor who own the same assets as the index in a C Corp fund would have had a 55% return on their money. And with the proposed tax reform and reduction of the corporate tax rate to 15%, the returns increase 30% in the same fund. So 85% is what an investor would have got who owned the underlying holdings of the index. Now, under the new 15% corporate tax rate, the returns would have increased to 73%. So from the current tax rate, it's a 30% increase in performance. Another way of looking at it, and a lot of articles have been published online primarily of looking at this, which is called tax drag. It's one of the major criticisms against MLP funds that own 100% of partnerships within the fund, which is the true pure exposure to the asset class, which is a positive. Has been this what they call the tax drag, and it's that tracking error. So historically, the underlying funds produce, again, 65% of the returns of the underlying index. Under the new tax regime, the funds would produce 85% of the returns of the underlying index. So these are not minor differences as the tax rates come in at 15%. These are seminal changes for the MLP asset class, and as investors start to understand the magnitude of the benefits, I think it will drive more investors into MLP funds, as well as bring more investors into the underlying asset class. So there's we looked at MLPs coming into last year, 2016, and after the bottom was put in oil, and at $26 a barrel on February 11th. That day is etched in my mind. I still have nightmares about it. So that we saw oil double from the bottom. We've seen production climbing in the United States. what we have done as a firm through the downturn, as part of our active management, we moved the portfolio and positioned it in larger cap names with long-term contracts that would have access to the capital markets, the safest portion of the MLP asset class. As we started to see that we were in the early stages of a cyclical recovery in the asset class, we started to move closer to the wellhead. We moved away from the wellhead to get into a defensive posture. We moved closer to the wellhead to get and pick up excess returns, which is what you pay managers to do, to generate alpha if we're doing our job correctly. And so we moved closer to the wellhead to get excess return, which has led us into more gathering and processing. And then going a step further, you start to look at moving into your E&P companies and your oil field service companies. So frac sand falls into the oil field services industry or subsector of energy, and it's one that we feel extremely positive on, and for two reasons. Number one, it has two tailwinds that are propelling it forward. One is the cyclical, which on a quality basis is less valuable, because cyclical investments, they go in cycles. They trough, and they usually get to pretty low in a trough, and then it peaks, and it gets pretty high in a peak, and then it rolls over and repeats the cycle over time. It doesn't mean you can't make money on cyclical investments. It's just you need to get in at the bottom and sell at the top. These are not investments that you buy and hold for the next 20 years. So cyclical is lower quality. The one we like is a secular change that's going on, and we're going to touch on both of them. The first slide is the cyclical change and or tailwind that's really positive for the frac sand industry, as well as other industries, oil field services in general. U.S. rig counts continue to rise. Rig counts are up over 100% since the bottom. They're over 900 right now, as of last Friday, which is the most recent data that's published on rig counts. So the cyclical uptick in rig counts, ultimately, rig counts are a great leading indicator of future production. If you don't drill for oil, you're not going to bring on future production, because these are declining assets. So you first need to drill. When you're drilling, then you see future production come online. The companies and the industries or sectors that benefit from drilling are primarily your oil field service companies. Are the first beneficiaries, because they're the ones that do the drilling. So they're called back on. They start to bring their rigs back in service that were backlogged. So they get a lot of operational leverage by this uptick in drilling. And then ultimately your E&P companies benefit, because they get the increased production after the holes are drilled and come online. They start to produce oil or natural gas, and their business model is volume multiplied by price of commodity equals your revenue. So rig counts continuing to rise is good for a lot of oil field service plays that are in the drilling business in the lower 48. So land drilling versus deep sea, which isn't doing so well right now. It's specifically very good for frac sand producers. Fracking is only takes place it takes place in the U.S. on land, not offshore right now primarily. It's in shale plays, so it's unconventional shale plays. Most of the drill rigs that are coming back online are horizontal drilling in unconventional shale plays. Wonderful for frac sand producers. So it's the right kind of drill rigs are coming back on in the right areas that are drilling unconventional wells in frac sand. So we have the cyclical recovery. Rig counts are increasing. We expect the growth of increase to slow. We don't expect it to get back to the peak of 2000 in the previous cycle. Rigs have become more efficient. They're able to drill faster, which is efficiency, and get the same amount of work done over a shorter period of time, which means you can move your drill in more places over the course of the year, so one rig can produce more drill holes than it could in the past. So that's the rig counts right now. They will continue to climb. Cyclical tailwind, number one. More importantly, to frac sand demand is something called sand intensity per well. And this chart below us goes from January 13th through last year, October 16th, to the fourth quarter of last year, where the data is available. And it's looking at average sand intensity per well. What does that mean? The amount of frac sand, which is put into the well to stimulate flow, has increased from under 2,000 tons per well over a 3-year period of time to over 4,000. It's a little shy of 4,500, and the numbers now are over 5,000. So you've seen almost a tripling of the amount of sand put in a well over a 3-year period of time. If you take that number and multiply it by the number of wells being drilled, is a good indication of the amount of sand being used. If you're drilling the same amount of wells and your intensity goes up 3x, your demand for sand is going to increase 3x. And so what we have seen here, and this is a secular tailwind, that the more sand that is put into a well has increased the amount of production from the well and recovery rates. And by increasing recovery rates and increasing production, you're actually lowering the cost on a per barrel basis, because it's the same fixed investment to drill the well. The more that you can produce from the same fixed investment, the lower your cost per barrel becomes, because you're taking the same fixed investment and dividing it by more barrels. That is, it's something I've been quoted at saying that's really similar to Moore's law. Moore's law from computing standpoint, that has more processing power, lower cost per chip over time, and we've seen that in play. Now what we're seeing in the oil field service is that recovery rates are increasing in unconventional shale plays, and the price per barrel is coming down because of increased recovery rates. The primary driver of that technology has been proppants, and frac sand being a proppant, so the most popular at this point. And we love the secular tailwind because everyone's winning. The greater the recovery rates are, the better the IRR for E&P companies. It's not a big cost of the overall cost of drilling a well. And what we're seeing here, the leading edge companies, so remember here we're looking at 4,500 tons per well, are putting in 25,000 tons per well, 5 times greater than the current number. And what they're finding from that is recovery rates are going up 70%. So it's not gotten to the point where these drillers have said, you know, the more sand we put in, we're actually starting to bottleneck the flows. The more sand we put in, the recovery rates are continuing to increase. So it's a statistic we've mentioned a lot in the past, and I know I'm throwing a lot out at you, but it's really exciting, is that recovery rates in unconventional shale plays are in the low teens right now, and they started at 10%, and that was enough to recovering 10% of your resource made economic sense. Recovery rates continue to increase. As recovery rates continue to increase, again, the cost per barrel goes down, so which gives the U.S. more supply, lowers our cost, makes us, we're already the lowest cost producer on a global basis. So if you look at production in the U.S. from our peak, we were at 9.6 million barrels per day. In the most recent cyclical peak, we dropped by, what was the number, Will?
Down to about 8.5, I think. 8.5,
and we're now back up to 9.3 in the most recent reading, and probably exiting this year at new record levels, probably just around 10 million. 10 million barrels a day, to put that in perspective, that's what Saudi Arabia produces, that's what Russia produces. We will be, and that's not including natural gas, we will be one of the largest energy producer, and in your lifetime, in my lifetime, I believe, that the U.S. will be the largest oil producer. And with natural gas and exporting of LNGs, which MLPs are right in the sweet spot of that as well, we have the U.S. energy revolution is alive and well, and right at the core of it is frac sand, because it's the technology that is driving productivity increases, and so we don't see it going anywhere anytime soon. Putting this effective, looking at sort of demand growth here in frac sand, if you look at the previous peak in 2014, 54 million tons were consumed in 2014. This year, the forecast is for 70 million tons next year, which is from the lows of last year, 2x, reaching a new peak in terms of frac sand demand. Clearly, rigs are not at the peak. You remember they were at 2,000 before. They're at under 1,000 right now. And then by next year, we'll have double the previous peak in terms of demand of frac sand. So it's a very exciting part of the industry, one where we think that there's a lot of money to be made in some of the frac sand names. Our strategy performance, and this is the final part of my prepared remarks here. We're going to look at all three today. And clearly our flagship strategy that goes back 16 years is a very different time frame than the others that were launched in October of 2015. So the growth opportunity strategy, if you look at it on a one-year basis through March 31st, 2017, a wonderful year, gross performance of almost 52%, doubling what the Alerian Index did of not quite, but 28%. So a significant amount of alpha was produced last year. If you look at it on a 5-year basis, which is what the table below shows, again, on the far right is our gross performance of 10%, and that's on an annualized basis over the past 5 years, relative to Alerian at 2.6%, 800 basis points of positive alpha over the index over that time frame. So our current assessment of the markets, and probably do not need to refresh anyone's memory on this, Yorkville is an expert in investing in U.S. energy infrastructure. It's all we do. So if we don't do it well, we don't do anything well. Last year we said we're in the beginning stages of the junk rally. Right now we believe we're into the secular recovery, where MLPs, the differentiation of high quality and low quality MLPs, and more specifically where growth MLPs should really start to outperform again going forward. And so it sort of plays into the sweet spot of the way we invest, and we believe we're entering that phase right now. So that's the performance on the Yorkville growth opportunities, MLP growth opportunity strategy. The second one is our high income strategy. Again, remember this only goes back to October 15th. These are our new strategies. They are a one-year basis. I did the same comparison. Actually, high income did better. It was up 65% versus 28% Alerian Index. Remember, last year we were saying to investors that this is the early stages, this is the junk rally phase of the recovery, that companies, partnerships that didn't go bankrupt, that weren't going to cut their distribution, were probably going to be the ones that were going to outperform. So if you look at the high income strategy, that indeed proved out. High income names were up 65% over in this portfolio, specifically doubling what the index did on an inception to date basis. Again, not quite a year and a half. You're looking at the performance of the high income strategy on year and a half basis, but this is an annualized number of 22.9% versus the Alerian up 12.7%. So good alpha of 10% per, on an annualized basis per annum over that period of time. And then finally, our Yorkville Energy Infrastructure Strategy, which invests in C Corps, again, over the one-year basis, up 66.2% versus 28.3%. So even delivering stronger returns over a one-year basis. On an annualized basis, it is underperforming slightly the Alerian Index, which is up 12.7 versus 9.6% over that same period of time. So it's really reflective of more. If you go back to October of 2015, we launched these right at the downturn. So the fourth quarter of 15 was a terrible quarter. The first quarter of 16 through February, even worse, if that was possible, as the great energy recession had its final throes, and then we moved into the recovery stage. So C-Corps have slightly underperformed MLPs as well. It's not just our stock picking within, and it's actually done well on a relative basis. So in fact, one of the indexes we'll be coming out with later in the year will be an index that just covers C-Corps, so we can have a passive benchmark to gauge our performance relative to. Thank you for your patience in listening to me for the prepared remarks. Yorkville Capital Management, we certainly believe in the power of partnerships and not only within our team and within the industry, but across the assets that we invest in U.S. energy infrastructure. Please look at our website. It's a great resource. It's built for investors. And if you want to reach us, we're always available. That's our direct line here in New York City, 212-755-1970. Will, I'm going to turn it back to you for questions.
Yeah, Darren, thank you very much for the informative presentation there. With that, we'll now begin the Q&A portion of the call. Just as a reminder, in case you haven't typed it in yet, if you have any questions, type them into the bottom right corner, that little text box there, and we'll do our best to answer all the questions. So we'll get right into it. Why don't we start here, Darren? Looking at OPEC, the meeting being next week, the 25th, in terms of the outcome, what do we expect to happen, and what happens if we get a scenario where they decide that's it, we gave away enough of our market share, no more cuts?
Okay. So what do we expect to happen? The 25th is the meeting date for OPEC, and what we expect to happen, and not only Yorkville, but the market consensus, is that OPEC will extend its production cuts. So what and where there's not consensus is for how long they extend their production cuts and whether they increase the amount of the cut. I'd say that the consensus is that they won't extend the amount of the cut, that the current cut will be maintained, so a positive surprise would be a greater cut. Oil would react positively to that, and an extension of 6 months would be, again, through the end of the year consensus. If the extension goes to 9 months, that would be positive as well. So holding production cuts constant and a 6 months extension, that would be what I would say would be consensus thinking. And the probability of that is fairly high. And I'll leave why we think the probability is fairly high. If they didn't extend cuts, then, and OPEC said, no, this is not working for us, maybe I'll have to kind of justify why they would possibly say that, then oil would drop from the 40s into the 30s. So would it go back into the 20s? I don't know. I doubt it. Short term, can it overshoot? Things always in the markets overshoot on the high side and on the low side. Without OPEC extending its cuts, the reason we entered into the great energy recession of 2015, which from an energy investor standpoint was as bad as the great recession of 2008 in terms of investment performance, that was caused by a oversupply of oil. And the primary cause of the oversupply of oil was the U.S. The U.S. over a 3-year period of time increased its production by 3 million barrels per day. And the world ended up with more oil than there was demand for it. So that led to an energy recession, and also Saudi Arabia and OPEC said we're going to try to hurt the U.S. producers by allowing oil prices to drop. So what ended up happening there was that the oil-based economies also couldn't sustain and function on oil under $30, or even the $30 to $40, and even $50 when we've done our analysis is probably not sufficient. And actually, we published that in one of our pieces looking at the break-even for countries. So, and then it's often touted that Saudi Arabia wants to take Aramco public next year, which has market valuations anywhere up to $2 trillion. It's a huge, it would be the world's largest IPO ever, and they want to diversify their economy away from being an oil-based economy into moving into new industries. They need the IPO to go through. So for all of these reasons, cheap oil doesn't work for anyone. Cheap oil didn't wipe out U.S. E&P companies. That the probability is the cuts will go through. Barring any unforeseen event like a global recession coming in, the oil markets will eventually organically rebalance. But that is, given the U.S. increased production, that's a couple of years out before we see that from decline rates in other fields. So OPEC is important to the overall equation right now, that they continue to be supportive of oil prices.
Okay, great. And then just while we're on kind of the macro side of things, this next question seems appropriate, especially given what potentially could happen if they were not to extend, although I think we both agree on that being a very low probability event. In terms of oil, why do we think it's been so volatile? What recently caused it to drop back into the low 40s? Why is it fluctuating? I mean, they're not as great dollar moves per se as maybe we saw back a few years ago, but on a percentage basis, they're big moves.
They are.
Well,
I take that.
Yeah, no, I'm happy to take it. I think really outside of what you're seeing with OPEC in terms of chatter and talk of whether they're going to extend, not extend, it seems over the past few weeks that things have certainly trended more towards a positive outcome for the meeting next week. Really, the focus has been on the weekly data points, which are U.S. crude inventories, U.S. gasoline inventories, and distillate inventories. And what was really kind of expected, I know we expected it, was OPEC agreed to cut in November. They were going to be implemented in January, and over the next few months, you would expect to see that flow through to the U.S. stockpiles. Eventually, without those imports hitting U.S. soil, you'd have to, demand would result in drawdowns in inventories. And I think the inventory numbers really disappointed in terms of how long it took for those cuts to really start to hit the market. And I think we're starting to see that now. We saw a strong draw in oil inventories past couple of weeks here. There's been talk of initially maybe floating storage was what was causing that to kind of be pushed off to the right in terms of timing a bit. But I think it's really just the data points that people have to work with are these weekly data points, and unfortunately that's going to drive volatility in oil prices. I think that being said, without having a look into the future, I think if we do get an agreement for 9 months, probably likely that we start to be in a much tighter band going forward. So,
which is exactly what we saw from November on. Oil traded in a couple of dollar range for multiple months until this most recent pullback.
Yeah, exactly. Another question here. Can you please explain the total amount of slippage from the beginning of revenue generation to the end investor in your investment vehicles? I think one important point to clarify is that slippage, that tax drag that Darren was referring to, was for investors in MLP funds, so those structured as ETFs or mutual funds or closed-end funds. The two new strategies that we're introducing today, maybe at some point down the line they find their way into those structures, but for now we're currently only offering those as separate accounts where you have direct investment. So as Darren mentioned there would be none of the corporate tax drag associated with that slide where we looked at differences in a 35%, 15%, and 0% scenario.
Right. So I think to just clarify that, from a tax slippage perspective, there would be none in terms of the underlying performance of the index on a gross basis would go directly to the investor. And then the question of anything beyond that would be the investor's personal taxes, whatever they would have to pay on the percentage of income that was not tax deferred.
Correct. And then it would just be, yeah, and these are actively managed, right? So we're going to be making decisions in terms of stock selection as opposed to the ETFs out there.
Correct.
Another question here, how do you look at, and what's your outlook for the global oil supply? That's a pretty...
Well, I touched on it earlier, and our outlook is that OPEC is was producing, coming into their cuts at record levels prior to, again, this most recent cut. So even cutting from record levels, it was over 33 million barrels roughly per day. So taking 1 million off that is not a big percentage cut. 10% would be 3 million barrels, so a 3% cut basically of production. Russia's producing at record levels, so then you have another 10 million barrels coming on there, roughly a little more, but between the two, there's 40 million of over 90 million of global production. So not quite half, but it's close enough to half the production. And then, yeah, the U.S. and you're over half. There's not a lot of latent supply that's coming online anywhere. The only country that can ramp significantly is the United States, and we're ramping significantly. So we're the swing factor in global oil supply right now. Everyone else, if you look at the majors, ExxonMobil, Chevron, Texaco, Total, BP, British Petroleum, they do not have, their growth rates aren't ramping dramatically. So number one, if you're an oil producer, you have decline rates. These are not assets that continue to produce in perpetuity. They produce a lot in the beginning. They produce less over time, and that decline rate needs to be replenished, and it's roughly 4% a year on a global basis. That needs to be replenished just to break even. So what we've seen happen because of low oil prices, well, that adds to uncertainty, and investor behavior is impacted by uncertainty. As investors, we don't like uncertainty. And when uncertainty comes, we're less likely to commit capital, especially capital for the longer term, and to develop projects over a multi-year period of time when we're not sure where oil will be in terms of pricing. What's happened is there's been a lack of investment over these past couple of years now. And so lead time to bring on new projects outside of OPEC is roughly 3 years from the time you've identified your resource to permitting, to building your plant, to getting the field up into production. It's a 3-year process. Well, over the last couple of years, we haven't seen new developments, new projects outside of non-OPEC coming on, nor OPEC projects, because OPEC themselves are spending their money to fund their budgets, right, and their social programs, and that's why Saudi Arabia went out to issue bonds and has cut back on social programs, because they're not making enough money from their oil revenues, which is another reason we'll believe they will keep production cuts in place. I digress. It's really looking at, though, that this lack of investment means at some point in the future we're coming to a cliff, which due to the lack of investment and the lack of the ability for current producers to meet demand growth and fulfill production declines, not even demand growth, just natural declines of production, that there will be a shortfall in the future. And that shortfall will have to come from somewhere. And when that shortfall comes in, again, lead time being a few years to fill, there is a possibility in a few years down the road, probably 2020 is a number that's being kicked around, and maybe a little earlier than that, that we hit what's called this cliff. And so at some point, it would be logical, there's a possibility for another oil spike until projects come back online. So we don't need an oil spike in the United States. Look what's happened with production, and the costs are coming down. MLPs, given our earlier slide, looking at the performance of MLPs relative to your other subsectors. They've held up quite well because they're not correlated to it. So again, keep in mind, infrastructure MLPs, 6.9% distribution growth rate. The growth leaders growing at 14%. These are growth company growth rates. I mean, Antero Midstream's GP went public, and who are they comparing themselves to?
I think it was Twitter, Snapchat, and Facebook in their roadshow.
Right, relative to the growth that they're going to be able to produce going forward. So MLPs and this U.S. energy revolution, it's a lie. It's real. These are real assets, and the primary beneficiaries, regardless of commodity pricing, as frac sand continues to improve recovery rates and lowers the cost, the U.S. price per barrel is just coming down. The cost it costs us to produce. So we are in a really a capper position right here on a global basis. We will be the incremental supplier of oil for the foreseeable future until we can no longer meet the demands, whether it's for lack of infrastructure or we can't drill fast enough. But either or, it's going to be because of capacity constraint is our long-term outlook on where oil prices go.
Okay, great. I think one point that really resonates here is the growth in U.S. production, right? Because almost regardless of what the kind of outcome is, that's something that we can kind of agree on, and that's going to be what drives a large majority of our portfolios and a large majority of the MLP asset class, which is midstream, and it's dependent on volumes like you mentioned. In the short term, we may have volatility related to daily moves or weekly moves in oil, but long-term things are headed in the right direction. We just reached the year-over-year increase in U.S. oil production, and that's going to just only continue to benefit distributions and growth going forward.
And the other aspect that investors get so focused on within U.S. energy infrastructure is oil, and we leave out natural gas. I mean, the real revolution has been a natural gas revolution. We have 100 years of supply of natural gas, and the price of natural gas came down from $15 per MCF till now it's around $3 per MCF. And producers are still producing natural gas and making money on it. So, and now we're exporting natural gas. We're exporting oil. So even without and natural gas doesn't fuel automobiles, which is more cyclical. Natural gas is base load demand for energy. So you don't get the same fluctuations in demand on natural gas as you potentially get from oil. It's less cyclical. So this asset class is maturing, and there's a lot of areas for investors who are experts in it to position portfolios over different parts of the cycle to capitalize on secular and cyclical trends or protect them in downsides with companies that are either affiliated with utilities in the United States, shipping LNG across the seas in long-term contracts. MLPs, it's not cyclical, and we said that for years. Hopefully the chart on the earlier slide that compares it to other asset classes and relative to oil also demonstrates that. Now, so having said that, that if we see a big pullback in oil again, MLPs will trade off because there is 08 demonstrated that, 15 demonstrated again. It doesn't mean your income's not safe, because Yorkville's demonstrated it in both periods of time. Income was safe in 8, income was safe in 15, but you're going to have some price volatility. So if you're a long-term investor, you keep focus on the income generation of the portfolio. That's what you're living off of. Don't worry about the price so much. But again, we don't see that as a problem in the foreseeable future. Again, we see this as we've come through the downturn in 15. We had a cyclical recovery last year, and now we're moving into the expansion phase of MLP. So on that note, I think we're over an hour. I don't think we are over an hour. Let's
Yeah. No, thank you so much, everyone, for joining us today. We are past over an hour now on the call, so I think we'll leave it there. It's a good place to leave off. As a reminder, replay of the webinar will be available in the next few days on our website, www.yorkvillecapital.com, and we look forward to speaking with you come next quarter. Thank you.